Okay. Sorry I was late. Is this on? Yeah? Yeah. Sorry I was late. I was answering an email from a student who was frustrated with the midterm grading. Anyway, so I was doing class stuff. Today we're going to talk about how trade enters into the macroeconomy. So we're going to complete our model of the macroeconomy. We've now added prices and interest rates, and today we're going to add exchange rates, which is the mechanism by which trade occurs. When two countries trade that have different currencies, there has to be some way for one currency to be translated into the other currency, and that's what exchange rates do. So the exchange rate is the price of one currency, like dollars, US dollars, in terms of another country's currency, like pound sterling. For example, these numbers I'm giving are because they make the arithmetic that we're going to do later extremely easy. See, they're multiples of 2. Actually, the exchange rate's a little different. I'll tell you in a second. But for example, you can buy a pound sterling for $2. Costs $2 to buy 1 pound sterling. Or if you have pound sterling and are wanting to buy dollars, then you have to have half a pound sterling to buy $1. The actual exchange rate is, does anyone remember? Anyone been to England recently? It's about, yeah, 1.6 as instead of 2, and 0.65 about instead of 0.5. So it's similar to this, but and Britain didn't join the Eurozone, so they're somewhat insulated from these problems that are occurring right now. They decided to keep their own currency for a while longer. The main thing that exchange rates do is to determine the prices of goods that are imports and exports to each country. So for example, the United States, one thing we sell a lot of is defense products, fighter planes. We sell them to the rest of the world. And so a fighter plane that the United States is selling for $3 million, given the exchange rate that I just gave, means that in Britain, if they want to buy any of our fighter planes, they have to come up with 1.5 million in their own currency, translate it into dollars, and then buy that fighter plane with those dollars. So the United States manufacturer ends up with the $3 million that the price is, and the Brits who are buying it have to come up with enough of their currency such that through the exchange rate they can buy it. Similarly, it works in the other direction, the British. Have you noticed how I do deprecating little examples of all the other countries? They make sweaters. So a 10-pound sweater that they're selling for 10 pounds, if you want to buy it in the United States, you got to come up with $20 in US dollars, exchange it into pounds, and then you'll have those 10 pounds. So essentially that's what the exchange rate does. It allows currencies to be, or people in one country to buy goods and services in another country. It also works the same way for investments. If a person in Britain wants to invest in the United States, buy bonds or whatever in the United States, then they need to translate their pounds into dollars to do so. And if a person in the United States wants to buy bonds in Britain, we need to translate our dollars into pounds. So it's essentially a way for cross-country trade to occur, both in goods and services and in financial instruments. What happens then, notice that the exchange rate is always reciprocal. You can denominate the price of dollars in terms of pounds, how many pounds it takes to buy $1, or equivalently, how many dollars it takes to buy 1 pound, and they're just the flip of each other. So when a currency depreciates, that means that its price, when denominated in other currencies, drops. So it's then cheaper for people in other countries to buy $1. And of course, what that necessarily means is that if one currency depreciates relative to something, like if the dollar depreciates relative to the pound, that necessarily implies that the pound appreciates relative to the dollar. So because they're just the reciprocal of each other. So for example, if the dollar depreciates, and instead of costing half a pound to buy $1, if you're a Brit, it only is 1/3 of a pound, that means the price of a dollar has gone down to people who are wanting to buy dollars. This is always very confusing. I always find it hard, the price of a dollar, because we're accustomed to thinking of prices as being in dollars. But this is the price of a dollar in some other currency. Okay? In this case, British pounds. And what this means, of course, is that the cost of a pound, a British pound, has risen to $3, where if we want to buy a British pound, we have to now come up with $3 and convert it to 1 British pound, up from 2. So what that means is that when the dollar depreciates relative to the pound appreciates relative to the dollar. And the main effect of this, or one of the main effects, is changes of the prices of imports and exports. As we described just a couple minutes ago, the main purpose of exchange rates is to determine how much people have to come up with of their own currency to buy goods in another country. And when that exchange rate changes, then it changes that amount. So for example, what we had before, if the dollar depreciates, now it only takes 1/3 of a pound to get a dollar, then the cost of a fighter plane has now gone down for the Brits. The amount that the United States is selling it for, the manufacturers here, is still $3 million. But now the people in Britain can buy it by only coming up with 1 million pounds of their own currency and converting it. So it has made our exports to Britain cheaper to the Brits. And it's made our imports from Britain more expensive. So a depreciation of the dollar means now the appreciation of the pound, which is implicit in our depreciation, means that we now have to come up with more money to come up with 10 pounds worth of British sterling to buy a sweater. So the depreciation of the dollar has made our exports cheaper abroad, it makes it easier for the Brits to buy our exports, and makes it more expensive for us to buy imports. Well, what's the immediate conclusion from this? Depreciation of the dollar helps the U.S. economy. This is a very badly known fact. It's something people don't really realize. It's actually good for our dollar to depreciate. People often see this as they read in the paper, oh, the dollar's depreciating, and say, oh, that shows that we're getting weak. In fact, that term is even used. The dollar is weakening. Sounds like we're getting feeble and, not doing too well. But it's actually the exact opposite. We should be happy when the dollar depreciates. It makes our exports better sold abroad because it makes them cheaper abroad, and it makes imports, our citizens spending money on other people's goods, less advantageous because it makes those imports more expensive. So actually a depreciation of the dollar helps the U.S. economy, and we should be happy when it happens. Similarly, an appreciation of the dollar hurts the U.S. economy, just by exactly the reverse concept. I think it's maybe this idea that depreciation is bad is because whenever you see graphs and things go down, we're just trained to think that something's the matter, like profits are going down or whatever. But it's actually, it's a good thing. In fact, many countries, think of one, keep their currency at extremely low prices, very depreciated, for the purpose of spurring exports. China, they're the most famous among them. Yeah. Well, the question I think is it wise for China to do what it's doing? I will leave that up to the Chinese. It's a hard thing to sustain, and it has, but they can make the choice on the long-term gains versus the short-term gains versus the long-term problems that are associated with it. And that's kind of what we're going to talk about. So yeah. So then that comes up, what determines the exchange rate when you don't have government intervention like China is doing? The exchange rate is a price. A currency is a good, just like anything else. And how are prices for goods determined? Through the demand and supply of the good. So if we want to talk about the exchange rate of the dollar, which is the price of a dollar in terms of other currency, then the quantity here is dollars. That's how many dollars people want to have. And this is the exchange rate, which is the price of dollars in terms of some other currency, say pound sterling. So it's a strange graph in that you're accustomed to seeing dollars over here and quantity down here, but now the quantity that's being exchanged, the good that's being exchanged, is physical dollars. And this is the price of dollars in terms of the currency that you're considering. How much the currency, say pound sterling, do you have to give up to get $1? And there is a demand for dollars and a supply for dollars. And the equilibrium of these two determines the exchange rate. But let's talk about each of these, what causes them or what determines the demand for dollars. Why do people want to buy dollars? Why do people in Britain want to buy dollars? The reason is because they want to buy American goods and services. Fighter jets, exactly. And if they're going to get one of our fighter jets, they're going to have to come up with some dollars to do it. And so they want to exchange their pound sterling into dollars, and so they're demanding dollars. They're wanting to buy dollars with their pound sterling. And of course, as we've just explained, as the exchange rate gets lower, as the dollar depreciates, gets cheaper, those fighter jets become cheaper to buy, and so people are going to want to buy more of them. So there's going to be a larger demand for dollars when the price of a dollar decreases. The other thing that people want to do when they, with their pound sterling, is maybe not buy goods and services in the United States, but make investments in the United States. If you want to buy a bond or a treasury bill in the United States because you think maybe it's more stable than in Britain, then you need to the British person has to translate their pound sterling into dollars to be able to do that. And so this represents the amount that people who hold pound sterling want to buy of dollars with their pound sterling. And then you have a supply curve of dollars. This is people who currently hold dollars and are wanting to get rid of them. They're wanting to exchange them for, in this case, pound sterling. And it's upward sloping because again, the reason an American citizen would want to translate their dollars into pound sterling is to buy British goods and services. And the more the dollar appreciates, becomes more expensive, it becomes ever more expensive to buy those goods and services. Our imports become more expensive. So to come up, to buy a sweater now, instead of it costing $20, it costs $30, and you're less willing to buy it. So you're, wait now, am I saying this wrong? Okay, think about it this way. Erase what I just said. As the dollar appreciates, it costs more to buy the same amount of goods and services from Britain, and so you're going to buy more of it. This has a tinge to elasticity in it, doesn't it? Anyway, as the exchange rate gets higher, it becomes. See, this is every time I talk about this, it's confusing. As the dollar appreciates, that means our imports become less expensive, and we want to buy more of them. Okay, so I was saying it incorrectly. As the dollar appreciates, American citizens find British goods to be cheaper, and so we want to buy more of them, and so we need to exchange more of our dollars to be able to buy them. So that's why we have an upward sloping supply. And if anyone in the United States wants to invest in Britain, then you need to supply them too. And there, of course, needs to be an equilibrium. And this is after you've written up the demand and supply curve, you get an equilibrium exactly the same way you would for any other market. Now let's look at things that would change. And the ones I'm going to choose are the things that are most important for understanding the full feedback on the macroeconomy. So we're going to come to these later, but I want to describe them right now. If anything causes the demand curve to shift outwards, then that's going to cause the dollar to appreciate. The most important factor that would cause the demand curve to shift outwards is an increase in the interest rate in the United States. If the interest rate in the United States goes up and the interest rate in Britain stays the same, so the only thing that's happened is the United States interest rates have gone up, then people who previously were investing their money in Britain would now rather invest in the United States because they can get a higher interest rate. And so they need to convert their money from pounds to dollars to do so. And as a result, we'll have a higher demand for dollars. Notice that this interest rates is not given on this graph. And that's why it's represented by a shift in the curve. The price of imports and exports are given by the exchange rate, which is given. So as the exchange rate rises, or better yet, as the exchange rate drops, the price of exports to Britain goes down, so it's easier for them to buy them, and hence they want to buy more, they need more dollars to do that. But that's a movement along the existing demand curve represented by the effect of a change in the exchange rate. That's a movement down this direction. What we're now talking about is at a given exchange rate, if the interest rate changes, that represents a shift in the demand curve to where at the same exchange rate, you're now going to have everyone wanting to buy more dollars to be able to invest in the United States. So the main thing that causes an upward shift in the demand for dollars is the interest rate. If the interest rate in the United States rises. Same goes for the supply. Same story, but in reverse. If the United States interest rate goes down, then people who had previously invested their money in the United States now want to get it out of the United States and invest in Britain instead, because Britain's interest rate now becomes relatively good. If our interest rates drop and theirs stay the same, then they've become better. So people who have dollars are now wanting to convert those into pound sterling, get rid of them, and so that means the supply of dollars rises, and we get a new equilibrium with a higher supply of dollars. Do any of you find this graph a little bit upsetting? How often have we in this class ever had where one thing goes one direction, it shifts the supply curve, and when it goes in the other direction, it shifts the demand curve? Never. But that's what we're showing here. A downward shift in the movement in the interest rate causes the supply curve to shift out, and yet an upward movement in the exchange rate causes the demand curve to shift out. It's true as drawn, and you can think of it in that way, and this is the way our book does it, and I think is very useful to think about the analysis. However, there is an alternative way to think about this whole demand and supply thing that is equivalent and avoids that slight inconsistency with how we've always treated demand and supply before. You can think of there being a supply of dollars out there that's fixed. There's just some amount of dollars that are there, printed pieces of paper with dollars on them. And all that happens is the demand rises or falls depending on what interest rates are. So if interest rates in the United States rise, people want to hold more dollars to be able to invest in the United States, and that shifts the demand curve out. And if interest rates drop, then it shifts the demand curve inward because people want to get rid of their dollars and shift them to something else. So you could think of it that way if you find this analysis confusing because of the shift in interest rates having a different effect depending on which direction the interest rates are going. However, the advantage of thinking of it this way is I find it useful to have the demand curve represent people who currently have pound sterling and want to convert them to dollars. You can kind of envision those people. And the supply curve is people who currently have dollars and want to convert them to pound sterling. You can envision those people also. So it kind of this demand and supply allows you to think of those two groups of people in separate ways. And so I think this graph is useful, but it does have that bizarre aspect that a change in an interest rate has effect on demand or supply depending on which way it's moving. Okay, now given this, we now want to go back to our macroeconomy and add trade into it and then see how the exchange rate affects the equilibrium in the aggregate output and also the effectiveness of fiscal and monetary policy. Okay, so we go back to our original graph, our original concepts of planned aggregate expenditure determining the amount of output in the economy. Now what we have to recognize is there's actually a new group of people who are buying American goods and services. We have consumers, just like we always did, consumers in the United States. We have firms in the United States who are investing. We have the government in the United States who's buying goods and services. Now we have all the rest of the world buying our exports. So there is another element that's added to planned aggregate expenditure, another group out there buying goods and services. So the total amount that is purchased of all the goods and services in the United States has these three that we originally were talking about, plus the demand by the rest of the world for the United States goods and services. That's the first thing to recognize. Whoops. The second thing is that the consumption of U.S. citizens, the amount that U.S. citizens decide to spend on consumption instead of saving, is not all spent on domestic goods. Some of it can be spent on foreign goods. And so it does not become part of the planned expenditures of on our goods and services. So we need to subtract that out. What we have here is the consumption. This is the amount that people decide to spend on goods and services out of their income, and subtract from that the amount that they're spending on foreign goods and services. What's left is the amount that is being spent on domestic goods and services. So now we have planned expenditures on U.S. goods and services is the amount that consumers buy after we've netted out what they buy of foreign goods, what firms buy, what the government buys, and what the rest of the world buys. Now it's customary, this is the most intuitive way to look at it. You have one component for each group of buyers, in a sense. But it's customary to rearrange this and put exports minus imports at the end, just moving this at the end. So this is the more common way to draw it. And it's kind of the components are consumers, firms, government, and the net impact on the rest from the rest of the world. And then you get equilibrium just as you would before. There's nothing new here. You set this equal to output Y, solve for the Y at which there's equilibrium. So there's nothing new except we now have an extra term in our planned aggregate expenditures. This final term that's added, exports minus imports, is our balance of trade. And as you could see from the previous graph, it's just an extra term that is added to planned aggregate expenditures. And so when that extra amount is positive, we have a positive balance of trade, that increases our aggregate output. If we have exports that exceed our imports, then we have a positive balance of trade, and that pushes stimulates our economy. If we have a negative balance of trade, it lowers our aggregate output. Traditionally, the United States has had a negative balance of trade, but it has had a minimal impact on aggregate output because it's relatively small compared to the whole size of the economy. Okay, so that's the way you work through the impact on aggregate output, and it's relatively straightforward. There are some implications of this, though, for fiscal policy and for monetary policy. Once again, we're going to find that fiscal policy is muted because of the existence of trade. So everything that we've talked about from the very beginning, interest rates, prices, and now trade, each of them reduces the effect of fiscal policy, makes fiscal policy less attractive than it might otherwise look. How is that? The first thing to recognize is that the G multiplier, as we had calculated it before, is necessarily lower when there's trade. For example, using the long example we've been having before, if people have a marginal propensity of consume of 0.75, we had previously calculated the multiplier to be 4. But what if instead of spending all 75 cents of a dollar on domestic goods, people spend 10 cents of it on foreign goods? Remember what this multiplier was, this marginal propensity to consume was doing. There's government spending, that increases the economy by whatever the government spending is. That becomes income to someone. They spend a portion of it, which stimulates the economy by that amount. That becomes income to someone, and you get this ripple effect. But notice this 10 cents that they spend on foreign goods is not a stimulus to our economy. It's a leakage out of our economy. And so it doesn't necessarily, shouldn't count when we're doing this ripple effect of the first dollar creates income for someone, they spend it, and that becomes income for someone, that kind of thing. So what this means is we have to reduce the marginal propensity to consume by the marginal propensity to import. It's the amount of each dollar of extra income that a person spends on foreign goods and services instead of domestic. And what that means then is that the multiplier, using the exact same logic we did before, the multiplier is calculated with the term in the bottom here being not the marginal propensity to consume. That was calculated when we thought all of that was going back into the U.S. economy. We only put in the amount that's going back into the U.S. economy, which is marginal propensity to consume minus the marginal propensity to import. So with this correction, this number here is always smaller. Subtracting it out, this is always larger, and this is always smaller. And as we've shown here, it's 2.8 in this example, quite a bit smaller than 4. Notice that when an economy is relatively closed and doesn't have lots of trade, then, and hence marginal propensity to import is relatively small, the decrease in the multiplier is relatively small. And as we get more and more enmeshed in trade, fiscal policy becomes less and less effective because of this effect. So essentially, over time, as we've gotten more and more enmeshed in global trade, the ability of fiscal policy to stimulate has somewhat disappeared, or not disappeared, but been mitigated. Stimulus policies that worked very well in the 40s aren't going to be quite as effective now. So trade reduces the effect of fiscal policy. That's the overall conclusion. But it does it in two ways. I just described already that the G multiplier is lower because in that ripple effect of the multiplier playing out of income becoming spent and then becoming income to someone else who spends part of it, that is muted. Okay? That's what we just described. But there's a second effect also that is propagated by trade and makes fiscal policy even smaller than the reduction in the G multiplier, as we described, would imply. Well, once again, you got your notes? Does that show up correctly on your notes? What happens is, if the government spends more money or reduces taxes, the G spending goes up. The immediate effect of that is to raise output in the economy. That was the intended effect. But as we've already seen when we looked at the market for interest rates, because the aggregate output of the economy is larger, the demand for money rises, and the demand for money rising causes the interest rate to rise. What happens when the interest rate rises? When the interest rate rises, people want to put their investments, want to buy bonds in the United States instead of where they originally had them. People in Britain and other countries want to convert their holdings from being bonds in Britain to being bonds in the United States because now they get a higher interest rate in the United States. So that causes the demand for dollars to rise, and that causes the dollar to appreciate, and that causes our exports to go down and our imports to go up, which then reduces aggregate output from what it originally had been increased to. So again, these take a while to play out, but the fiscal policy, it definitely has an immediate stimulatory effect. But then it has all these double whammies of losses from various things. First of all, there's the higher interest rate causes less consumption and investing, so we have a slight reduction in output because of that, and because there's less investing, we have less productive capacity in the future. So we lose a little now from that, and we lose a lot later for that. And the higher interest rate then causes the dollar to appreciate, which hurts our export industry and causes our consumers to buy more imports, which hurts our economy also. So it really is, fiscal policy is truly something you should only engage in as a final resort. When all of these are played out, the final eventual effect of fiscal policy might not even be positive. It will give a positive increase at first, but after all of these things play out, it could actually end up being detrimental. The only reason you would ever want to have fiscal policy is when there's nothing else to be done. When we need a spurt to the economy to get us going, and we're willing to pay for it in the long run. This is very important, and this somewhat reconciles the views that are being expressed today. Many people still think we should stimulate the economy. I personally believe that too, with fiscal policy. We're in a period where I think it's worth it. However, all the people who are against that point to all the problems of stimulatory fiscal policy, that it reduces investment, it hurts our exports, it eventually plays itself out, it increases prices. All of those things are true. It's just a matter of how you're willing to trade those off. And so the controversy always becomes much more heated than something like this nuanced understanding should lead to. I mean, you can really understand other people's beliefs that fiscal policy is not good or fiscal policy is good. It's just, you got to come to your own decision on whether you think it's worthwhile now. Okay, so fiscal policy, again, and the more we have trade, the more we're incorporated into a global economy, the less effective fiscal policy is going to be. What's interesting is that the opposite occurs with monetary policy. This is a kind of ongoing theme here we're seeing. Monetary policy looks better and better every time we look at it, when it's possible. Monetary policy actually stimulates the economy beyond what it would have been stimulated without trade. So recall what happens with expansionary monetary policy is that the supply of money goes up. That causes the interest rate to go down. Insofar as firms invest more when it's cheaper to borrow money, and when consumers consume more when it's cheaper to borrow money, that is, they can't loan out and get as much interest, then that causes aggregate output to rise. That's usually the case. The downward movement of interest rate causes output to increase in the economy. That's the purpose of stimulatory fiscal monetary policy. What happens then is the supply of dollar rises because the interest rate has gone down. So once again, fiscal policy caused the interest rate to rise. That caused the demand for dollars to decrease, to rise. Here it does the opposite. The interest rate rises. Now people who are investing in other countries want to invest in the United States instead, so they convert their pound sterling into dollars. Oh, wait now. No. See, I said it wrong again. It is very easy to get caught up on the directions. The interest rate goes down. That means investing in the United States becomes less advantageous. So people who have dollars want to get rid of the dollars and get pound sterling instead, or some other currency, to be able to move put their money in bonds in other countries. So that means the supply of dollars rises. That causes the interest rate, the dollar to depreciate, which causes exports to go up and imports to go down, and the economy to be stimulated beyond what it was originally. And notice that this happens more the more we're entwined with other countries. So in a sense, the effectiveness of fiscal policy is enhanced and improved with our greater incorporation in global trade. It's not just because of as we get more imports and exports. That is a key component. But it's also because the supply of dollars rises. It maybe is hard for you to recognize this because most of us don't do this, but there are trillions of dollars passing borders based on tiny changes in interest rates. People trying to catch that slight higher interest rate someplace else. So when interest rates in one country change, there is an enormous change now in the demand for currencies in response to that. And that is what causes the currencies to change, depreciate or appreciate, and has the effect on the economy. So what this means is, again, we should try to use monetary policy when possible. There is, however, one more problem with monetary policy that, other than the one we've already mentioned. We've already mentioned the liquidity trap. What can happen is if interest rates go down and firms don't respond by investing more, they're still too nervous to invest, then that's not going to stimulate the economy. Or if interest rates go down and consumers still don't spend more because they're all hunkering down waiting, to see what's going to happen, that won't stimulate the economy. That's the liquidity trap that we talked about, and that's when monetary policy simply won't work. You have to do fiscal policy. The other thing that can happen now, though, as soon as we've had trade, is that other countries can react to our monetary policy. And in fact, they do react to our monetary policy and can be expected to. Why? If we have expansionary monetary policy so as to help our economy, our dollar will depreciate. What does that mean to other currencies? They will appreciate, which means that we're hurting their economies. So by our dollar depreciating through our expansionary monetary policy, when our Federal Reserve Board is trying to help our economy, that necessarily translates into us hurting other countries' economies. Because the flip of it is their currencies appreciate and their exports go down and their imports go up. What they do then is retaliate. Other countries will engage in their own stimulatory fiscal monetary policy, both to counteract what we did and simply because their economy has been hurt and so they need some help to get it going up again. And so then you can get into this tit for tat thing that is exceedingly dangerous for all countries. An issue with monetary policy that always has to be considered is the impact of the monetary policy on other countries, and this needs to be worked out. This is why our central banks talk to each other, why the countries tend to cooperate. It's much better if the countries work out together how much each country should be able to lower their interest rates to stimulate their economy without hurting other countries. The term that's used here is a country accuses another country of exporting its problems. Essentially, if the United States is having problems, we have high unemployment, we have stimulatory monetary policy, that gets rid of our problems by exporting it to the rest of the world. And all the other countries are aware of this. So the monetary policy is more effective when there's trade, but we've now become more interdependent on the reactions of all the other countries, and we need to take those reactions into account and make sure that everyone's on the same page when involved in this. So that again makes monetary policy a little less effective than we would previously hope. That again raises the issue of when we're now, as we are, in a somewhat global downturn, trying to use monetary policy not only has the issue of a liquidity trap in the United States, but also has a problem of more reaction from other countries because they're already having problems of their own. So once again, this points out that maybe now is the time to do fiscal stimulus, even though we know it's going to be something we have to pay for a lot in the future. Okay, any questions? Last lecture is Wednesday. Oh, hang on. Yep. Why don't you come up and talk after? Yeah. Okay, see y'all.